Hi. A common question for financial advisors is what's the difference between a mutual fund and an ETF or exchange traded fund, and which one is right for me as an investor? Today I want to go over what are some of the similarities and differences between these two financial investment products with a focus on how they're traded, the fees and expenses, and the tax efficiency of each. Let's start with trading. If you look at this table here, you can see the main differences between trading mutual funds and ETFs. The first thing that you'll notice when you go to put it in an order is that with mutual funds, you're not trading live. That is, the order that you put in is not going to be traded until after market hours. That is, sometime around 6 or 7 p.m. at night, the mutual fund companies let the world know what their prices are of each of their mutual funds. And this is based on all of their underlying assets, all the securities that they hold. They add them up and tell you what the net asset value is. And then whether you put it in a buy or a sell order, that's the price you get. With exchange traded funds, on the other hand, you're buying and selling it like a stock, and it's done throughout the day. So you'll see the prices flashing up and down as buyers and sellers exchange shares. One thing to understand when you're buying or selling an exchange traded fund is that it could be trading at a premium or a discount to the actual value of the underlying holdings. That's not true with mutual funds, so be aware of that before you place a trade. Lastly, with an exchange traded fund, you can only own whole shares. A mutual fund allows you to buy fractional or partial shares, but with the exchange traded fund, you're holding whole numbers of shares. A mutual fund might have a limit on the minimum you're allowed to buy, so it might be a minimum of $1,000 or a minimum of $100,000, but you can own a fraction of a share. Not so with exchange traded funds. When it comes to fees and expenses, this is where we're going to run into some of the key differences and also an area of significant confusion and misunderstanding about mutual funds and ETFs. If we look at this helpful Venn diagram, we've got mutual funds and ETFs contrasted with each other. And you'll note that the ETF side doesn't have a lot of fees associated, if any, that are not also present in mutual funds. For the mutual funds, there are some different fees to be aware of. One is loads or sales charges. These don't occur in all mutual funds, but they do in some. And they can sometimes be charged when you buy the shares or when you sell the shares. 12b-1 fees are sometimes charged as well. This involves marketing, and it's included in the internal expenses, which we'll come to later. Lastly, there's this issue of redemption fees. Sometimes a mutual fund will say there's a redemption fee if you're going to sell this after only holding it for 90 days or so. The next thing to consider then are these fees that both mutual funds and ETFs have. A broker fee, a broker trading fee, is when you buy or sell a share and they charge you $5 or $10 to complete the transaction. Here is the area of the greatest confusion and misunderstanding. Internal expenses. This is an amount that is subtracted from the total value of either the mutual fund or the ETF on a regular basis, such that you don't see it, but this information is very easy to find. And this pays the company to manage the fund for you, whether that's actively or passively. You will often hear that exchange-traded funds have lower internal expenses than mutual funds, and that's true on average. But what I care about is the individual investment that you're buying. And in that case, many mutual funds cost less than exchange-traded funds. So it's not a hard and fast rule that the internal expenses of ETFs are cheaper. The main difference is that mutual funds are more likely to be actively managed than passively managed. That's not always the case, though. You can have a passively managed mutual fund and you can have an actively managed exchange-traded fund. So make sure you know that what you're buying. The actively managed fund is going to cost more because you're paying a portfolio manager to try to pick stocks or bonds that are going to outperform the market one way or another, either through less volatility or through greater returns. The passively managed fund doesn't pay a portfolio manager for this. They track an index with the goal of having minimal costs, and in that way hoping to do better than the actively managed funds. At this point, let's look at a couple examples. Here's a Morningstar page for an exchange-traded fund. It's being traded live and it has a certain value as shown in the chart here, and you can see it's going up and down throughout the day. If you look at the category in the bottom right corner, you see this is a large blend US ETF. So this is very much like the S&P 500 index. And if you look here, you see the expense ratio is 0.095%. That's a clue that this is going to be a passively managed fund. Typically, passively managed funds are less than 0.5% or less than 0.1% because there's very little cost involved in managing it. If we look at this mutual fund, on the other hand, you'll notice that it's the same type of investment, but there's no live chart showing the changing value throughout the course of the day. The other thing to note is that this is an actively managed mutual fund, and I'm hiding the title because I'm not trying to push any different funds on you. I'm just trying to teach you concepts. And in this one, the expense ratio is 0.84%. That tells me that this is actively managed. They're paying a portfolio manager. Typically, an actively managed portfolio a mutual fund like this will cost between 0.5% and 1.5% per year. So whether or not this manager is achieving his goals is uncertain, but this is how the fund is behaving differently. Now let's look at a couple counterexamples. Here is an actively traded ETF, and it's the same category. If we look at the bottom right, we see it's a large blend US fund, but if you look over at the expense ratio, it's 0.65%. As a reminder, a moment ago we were looking at an exchange-traded fund where it was 0.095%, even cheaper than that. So you can have an active, more costly exchange-traded fund. It might be worth the extra cost, but that's something that you have to determine later. Here is an example of a mutual fund that's passively managed. And you can see it's the same type of investments as those other funds. It's a large blend. It's US companies. The expense ratio is 0.015%. That's even lower cost than the passively managed ETF we were looking at a bit ago. So just because something is a mutual fund doesn't mean it's actively managed, and it doesn't mean it necessarily costs more than an ETF. The last area of difference that I want to talk about when it comes to mutual funds and ETFs is tax efficiency. Now, this doesn't matter if you're investing in an IRA, but if you're in a taxable account, a mutual fund might be less efficient than an exchange-traded fund. And the reason for that is that when the mutual fund buys and sells securities as they're going about their business of trading, they have to pass capital gains on to you, the investor. And you realize those gains in the year that happens. Typically this happens around November or December each year, but it can happen in other months. With an exchange-traded fund, you don't realize any capital gains until you sell the fund for a profit. So if there is an advantage to delaying realizing those taxes and paying those taxes, then the exchange-traded fund is probably the better option. In both cases, you're going to have to pay your taxes on gains, though. So it's not something that can be avoided, but the exchange-traded fund allows for the opportunity to delay some of this. Lastly, I like to finish my videos by sharing something that might make your life a bit richer in a different kind of way. So this is a piece of classical music that you may or may not have heard before, but I think it's really nice. This one is Franz Schubert's Opus 100 Andante con moto. It's a slower piece than what I typically share. It's only got 3 instruments. It's pensive, it's a little bit somber, but it's very pretty. And I think you'll like it. It's something that Schubert composed near the end of his very short life. Have a great week.